And the latest jobs report revealed a slightly slower pace of job growth in May, with the labor force participation rate little changed over the month at 62.3%. So what does this spell out for the Fed and the nation's economy? For more on this and to answer that question, we've got Hugh Johnson, who is the economics chief economist. And great to have you here with us today. Hugh, first and foremost, perhaps you can kind of shed some light on that question in itself. What does this tell us about the state of the economy right now?
Well, it tells you that the economy is in the process of slowing. The employment report is really, Brad, about the most important economic report that we get in any one month. It gives us a really good idea what's going on in the underlying economy. It's been in the process of slowing. We've seen numbers around, say, 600,000 average monthly change in non-farm payroll in the fourth quarter. In the first quarter, we see something in the neighborhood of 500,000, and now we're down to about, say, 413,000 for the 2 months of the second quarter of this year. So things are slowing down. I wish they'd slow down a little bit more. I think they will as we move through the remainder of 2022 and 23. But nevertheless, the economy is clearly, at least in my judgment, in the process of slowing down, at least if we measure it by employment.
But Hugh, even with the economy slowing down, do you think that will bring inflation lower?
You know, it's coupled with this, as we see not only a decline in the growth of jobs, but we're also seeing, at least from the employment report, we saw the average hourly earnings. They're also in some ways coming down, not by leaps and bounds, but nevertheless coming down. So when we look at a couple of months ago, 5.6% year over year growth in average hourly earnings. That came down to 5.5% for the month of April, and then now down to 5.2% for the month of May. So yes, you see the economy slowing, and yes, you see the upward pressure on wages is starting to be relieved. It doesn't happen in big numbers. It's not big steps, but nevertheless, it's headed in the right direction. So I think that's good on the wage side of the equation. We got to look at the price side of the equation. And I think, we're going to have a hard look at that when we see the consumer price index numbers on Friday. So I think it's headed in the right direction. I don't want to use the word transitory, but nevertheless, it's headed in the right direction.
Hey, Hugh, it's Julie here. I'm definitely looking forward to those numbers on Friday. What do you think would change the Fed's mind? Obviously, Jay Powell has been very clear. They're watching CPI, or in their case, probably PCE, very, very closely. What do you think the numbers would have to look like to get the Fed to slow down?
That's a really good question, Julie. I wish I knew the answer to that question. It's clear to me that if you look at the employment numbers and what that told you about the underlying employment conditions in the economy, is probably not enough. They've got to see steeper drops or much lower numbers on the employment growth side. They've got to see much better numbers on the consumer price index side. They're so obsessed. I don't want to say obsessed because that sounds pejorative, but they're very, very caught up in the notion of inflation being too high, and it is too high. But I think it's going to be in the process, and you'll see that on Friday, in the process of coming down, but probably not coming down fast enough. Julie, I wish I knew the answer to that question, but from everything I hear from not only members of the Open Market Committee, but also others such as Mr. Summers, you hear that inflation is simply too high and they've got to be extraordinarily aggressive. And they're really, I don't want to say they're ignoring the employment of the inflation numbers, but it's going to take a lot to get them to move or to pause in September. That's really what I want to see.
How well positioned is the Fed to actually achieve one of their goals in price stability, considering that so much of the instability is also annexed to something into the supply chain, which I don't believe the Fed has any measures necessarily to tackle the supply chain?
No, there's a great deal the Fed cannot control, and certainly upward pressure on wages is one of them, and the supply chain disruptions is another. It's important, Brad, I think, to recognize, though, that along with the better numbers, and again, they're coming down slowly, we're also getting an improvement, say, in the supply chain disruptions. First of all, it looks as though China might be relieving or eliminating some of the limitations they've had on economic activity and exports. That's part of it. Take a look at the automobile sales numbers, automobile production numbers, and you'll see that the semiconductor disruptions, supply chain disruptions, are starting to give way to much better conditions. So we're not only seeing some improvement, not great improvement, some improvement in the inflation numbers, but we're also seeing some improvement. I mentioned wages. I also would mention, importantly, supply chain disruption, seeing some improvement in the things that have caused the higher rates of inflation. Hopefully, the two will continue to come down continuously together. And then hopefully, and I cross my fingers on this, and I don't say this with a lot of confidence, I hope that, of course, the Federal Reserve will see this and they may consider, and I'm just saying consider, and may actually do back off or pause when we get to, say, September, the September meeting of the Open Market Committee.
Hugh, do you think there's anything the Biden administration can do to tackle inflation?
That's another great question. It's what they can do. First of all, we're talking about economic activity as part of the equation. And part of the equation is fiscal policy. And look, I think everybody here knows that fiscal policy in 2022, and I might add 2023, compared to what we saw in 2021 is significantly different. The level of spending by the federal government, spending to help those that are in trouble because of the pandemic, the level of spending is going to come down very precipitously in 2022. You really can't ask for more. That's going to help slow the economy. It's going to help make things difficult for consumers, but nevertheless, it's going to slow the economy. And I think from the point of view of what the Biden administration can do or what the federal government in Washington can do, taking their foot off the accelerator, and they're really taking their foot off the accelerator, is going to help to slow the economy. And I think that to the extent that it's possible is what they can contribute in a big picture way, what they can contribute to the solution to the inflation problem. Remember, when I say these things about fiscal policy or say these things about monetary policy, it's going to be really hard to get that number, the inflation number, down towards 2%, which is, of course, the Federal Reserve's longer term target. That's going to be a real hard job.